Welcome to another AMA. My name is John Belizaire, and I am the CEO of Soluna Holdings. I'll be answering shareholders and potential investors' most asked questions about our finances, projects over the next few slides. And if you'd like to see these answers in written form, please visit solunacomputing.com/blogs. Stick around to learn how to submit your answers at the end of this AMA. And of course, I want to thank everyone in advance for answering or sending those questions in. We're always happy to answer them to the best of our abilities, and we appreciate all of you every day. And the questions we have today, they touch on everything from AI to the halving to some of our sites, etc. And we do our best to answer some of those. Thank you. Before we begin, I'd like to start with some legal preamble. The following content is completely qualified by the legal disclosures on the slide following this one. Our goal is to share with you some of our strategic thinking and financial analysis that we are using to guide the growth of our business. The content is in line with our principles of being accountable and transparent with our shareholders. And of course, we operate in a hyper-dynamic economic environment, and that's a fancy way of saying things change quickly. What we're telling you here is based on our estimates and assumptions, which are our best guess, and we reserve the right to revise our point of view based on new information and changes in the business environment. Despite an uncertain dynamic environment, we must plan and make operating and investment decisions, and this presentation lays out some of that for you. So please quickly take a look at the disclaimers that follow. Okay, let's start with our first question. Michael asked, if you own 15% and 50% of Dorothy 1A and 1B, does this ownership mean you get exactly 15 and 50% of the generated revenue from these two sites, or does the revenue generated work in a more complicated manner? And for Project Sophie, since the revenue generated is hosted with Project's profit share, how does a rise in Bitcoin price increase the revenue generation? Is it a 100% linear way when Bitcoin goes from 15 to 60? Does Project Sophie's revenue increase 4x, or is there a fixed component in the revenue generation for Soluna, and possibly in what ratio? These aren't mentioned anywhere, and it's a little annoying for investors to reverse engineer calculate this information for the corporate provided numbers. Okay, so we own 100% of Project Sophie, and we own approximately 15% of Dorothy 1A and 51% of 1B. Now, as part of our partnership with Springland Capital, Dorothy 1A has a mechanism to increase our share of the profits after SLC achieves a certain return on their invested capital. After that point, we share in 50% of the profits. The degree to which each of the project's revenues change based on Bitcoin price really depends on the percentage of the proprietary mining exposure, the efficiency of the machines, and the optimizations we're running at each site. Project 1B is 100% proprietary mining, and Project Sophie benefits from a range of profit-sharing schemes with its hosting customers. So I think the best thing to see the effect of Bitcoin price is when we put out our earnings publication or illustration. In the 2024 version, we'll include a example where we change the Bitcoin price. We'll give an upside scenario, and you can see the effect by site on revenue and profits, and that should give you a sense of what that looks like. There's no sort of standard equation we can give you or detail for that, but we do give out these P&Ls and projections to give you a sense. Thank you. Marcus asked, how do you plan on paying off the company's outstanding debt? Well, there are three main elements on our balance sheet, debt-related elements. There's the convertible notes, there's the old NYDIG equipment loan, and there's a Navitas project-level debt facility. For the convertible notes, we've negotiated a series of amendments that allow us to either convert the note into stock or pay it in cash. Our current plan includes a combination of conversion as our stock performs and a pay down of the note in cash as it becomes possible for the company to do that. In the meantime, we have two extension rights available that give us another 6 months to extend the note into 2025. For the NYDIG debt, we've returned the collateral related to these loan agreements. Note these loan agreements are at a subsidiary called Project Marie. That has since been decommissioned, and the rest is a legal matter that is more fully described in our 10K. I suggest you read that. Now, for the Navitas debt, we have been paying that down with cash from the cash flows of Dorothy 1B on a schedule that is part of the amortization system in the loan itself. Thanks, Marcos. Thomas asks, given the notable improvement in operating results and EBITDA, how do you explain the large sell-off in the past week? In particular, the 10K mentions legal proceeding, one of which is NYDIG had an important deadline on April 12th, coinciding with the large sell-off. Was there any legal development that investors should be aware of? What could the impact on the company's cash position? Or was the sell-off unrelated? Well, we believe the recent sell-off was unrelated to the company's execution. In fact, for the record, nothing fundamental has changed about the company, as of this writing or recording. And our mission and focus is unchanged. Our execution plan is unchanged. In fact, our team is unchanged, although we did add a new CFO that we're very excited about, John Tunison. Great background. Our sites and partnerships are the same, and I would say our upward trajectory is also the same. So there was no reason why there should have been a sell-off, and so we'll leave that to the market to answer. Peter asks, can you reveal what kind of revenue the first AI hosting customer is creating compared to, for example, data hosting? Is the revenue continuous, intermittent? What kind of profitability is possible to reach with it in current market conditions? It's a good question. We have a fixed fee for co-location services, and we pass through the cost of power in the AI hosting model. So as the customer grows, this scales linearly. So the earlier question that someone asked before about how things scale, it's a lot easier to do with some of these classic services type structures. Anyway, when we run the math on a per kilowatt hour basis, this results in significantly higher revenue per kilowatt hour than Bitcoin mining. And that's one of the reasons we want to continue to diversify into this new market. Thanks, Peter. Peter also asks, can you provide information on ancillary services? What's the maximum revenue you can generate with it, with your current setup, Dorothy 1A, 1B, Sophie? What kind of conditions impact it, and from whom does the generated money come from? So at the moment, we only participate in ancillary services at Dorothy, so 1A and 1B. Each ancillary services period, there are several of them throughout the year, we bid into the ERCOT market in Texas to provide those services. So this is a demand response program, which essentially means, if the grid needs our power, we would curtail the site, deliver the power to the grid, and that earns us some revenue. And at the end of the period, what ERCOT does is it measures our performance, which is maintaining our load at a certain level, at that bid level, and it pays us a set fee for that, which is based on the megawatts that we submitted as part of the bid. The projections for 2024, the earnings power illustration that we put out in the coming weeks, will include revenue projections for ancillary services. We are breaking that out now, and so you can see what that projection looks like for the year. Thank you. Next question is from Zach. Zach asks, can you give us a more detailed breakdown of what the upgrade requirements and costs will be after the halving? We don't foresee any near-term upgrades required across our sites post-halving. For our proprietary mining at Project Dorothy 1B, our average power efficiency, or mining efficiency, if you will, is 28 joules per terahash, and I believe across our fleet it's approximately 25.7 joules per terahash. Our power price is $30 per megawatt hour or less, and that average changes over the course of the year, but that's our average. And it gives us a meaningful cost advantage that could be important relative to many other miners post-halving. So along with our relationship with Navitas Global at Dorothy 1B, we continuously evaluate, equipment strategy and potential sales, purchases, or swaps, and that allows us to determine what's the best structure going forward post-halving. But we do have different options there. Project Dorothy 1A and Project Sophie have similar efficiency levels. Our hosting customers are some of the industry's leading miners, and we've implemented a number of optimization strategies at each site to ensure maximum profit. Our hosting partners can upgrade their machines during the term or at the end of the term, and certain contracts at Sophie include a minimum fee to protect our exposure to halving and Bitcoin fluctuations. Thank you. Jonathan asks, can you explain to investors what the cost of data hosting revenue that's reported in your accounting numbers consists of? Do you have some potential plan to bring this number down? Intuitively, plugging it into other corporate companies, miners to your facilities shouldn't incur much cost, but the reported cost totaled $5.6 million for 2023. Jonathan, the cost of data hosting includes all the site-level direct and overhead costs that are associated with hosting. This includes site-level expenses such as utilities, power costs, labor, site maintenance, and operations management as an example. And Jonathan also asks something about our balance sheet. On your balance sheet, your Bitcoin miners are valued at about 11.7 or 9.1 million. Have you considered selling the miners to the markets and using the approximate 10 million to abolish debt and reallocate the freed up space to hosting? From an outsider perspective, you majorly reduce perceived bankruptcy likelihood, which would lead to better negotiated terms for new project financing in addition to other benefits. Jonathan, thanks. So as you can imagine, we're continuously assessing our asset mix and make determinations if assets are both sold or operated. Furthermore, we do regularly assess our debt structure, and we look to optimize it for any underlying risk and the asset mix. And we're considering the terms of the debt and the opportunity set that we have to pay down that debt. And we do that on a continuous basis. And that should give you a sense of sort of how we look at that, and we make those decisions continuously. Thanks. Well, that's it for today. Thanks for submitting your questions. If you're reading this and you haven't had a chance to ask questions, it's not too late. Fill out the form in the video description box below, or drop your questions on X, otherwise formerly known as Twitter. We're at Soluna Holdings to have your questions answered for our next AMA installment. Now, if your question wasn't answered here, be sure to subscribe to our newsletter, also linked in the notes, and we're providing business insights and answering questions there as well. Until next time.